Tax season's here. And for those who own, maybe looking to buy, you might be wrestling with the idea that if you are a higher earner, do you keep paying rent or do you buy? But a recent conversation with a client of mine was built around the fact that he recognized the mortgage interest deduction, once applied into his life from a taxable situation, means that his rent is the same as the mortgage payment once you take away the tax deductible interest that is written off. So what's changing? Three things we're going to talk about real quick. I just touched on one, but it's related to mortgage insurance. What that means is mortgage insurance is treated like mortgage interest for tax deductible purposes. So do the math, talk to your CPA. You can find calculators online if you Google them to understand how much will this change your tax return. Now, an old CPA used to tell me, if you are getting more than $1,000 or paying more than $1,000, you should adjust your W-4 if you're a W-2 wage earner. What is that saying? Well, if I got a $5,000 tax refund, I sure am pumped, except that I just gave the government a tax-free loan the whole year. $5,000 down to $1,000, it's $4,000. 50 more in my take-home pay would yield me a $1,000 tax return, which I'm better suited to have, and have the $350 a month. What could I do with that? Maybe that pays bills, put food on the table, invest, etc. $750,000 is the cap for mortgage interest write-off, and that is currently permanent according to the most recent changes. And talk to your CPA to better understand exactly how much it will benefit you as far as your mortgage goes. SALT deduction. Now, we're not talking about seasoning for a steak. We are talking about state and local tax, which was capped at $10,000. And with bill change, what that's going to mean is $40,000. So how does that affect you? Well, if you're in a higher cost area with high property taxes and you were capped at $10,000, but your taxes are, and those other write-offs exceeded that, you're now going to get that back into your tax return, which can benefit you and reduce your taxable income as well. So keep that in mind. It'll be raised from $40,000 with the 1% annual increase, but the phase out comes in for incomes over $500,000 for joint filers. Okay, so that is something. As an example, married couple in Denver, $8,000 in property tax, $15,000 in state income tax, $23,000, right? So capped at $10,000, but now that couple can take the full deduction of $23,000. The last one today is going to be HELOCs. This is a little bit murky. Did you know if you take out a home equity line of credit to pay off high interest debt, that's not tax deductible interest? If you take out a HELOC to permanently improve your home, that's tax deductible interest. Your CPA should be explaining this to you, but make sure you know that, because that is something to be aware of. You can also use a HELOC to buy an investment property and make it tax deductible interest as well. Again, I am not a CPA. I do not play one on YouTube, but the more you know, the better off you are. Use Google, use ChatGPT, get educated about this stuff so that it can help you out. If you're curious about, do I take a HELOC? Do I do a cash out refi? I've got a video for that. And as it relates to understanding these things, use the tools online and at your ready and at your disposal. If you have questions about any of these three topics, post them below. If you have experience with any of these three topics, I'd like to hear your feedback on it. If you like this type of content, make sure to like and subscribe. We'll be back with you soon.